Very good to see you, Dmitri. So is this result good for the Polish economy?
Yeah, that's definitely the case. First of all, it means stability, what is very, very important in this current environment of political instability within the European Union. So the second term is also positive for some further fiscal consolidation and maybe some minor changes in the structural reforms which we can expect in the next 4 years.
Fiscal consolidation, you're talking now about Tusk's biggest challenge, is that correct?
Yeah, that's correct. I think when they won their last election back in 2007, they promised some more radical reforms that they wanted to reduce some privileges for uniform services, for farmers. But actually, the market was a little bit more frustrating because they did not deliver any significant changes. It was just like small steps. And for the next year, they have to speed up some reforms definitely to make a little bit more on privatization front and just to impress the markets in order to be able to attract more direct investments.
Well, investors
because it was the main,
are concerned about this 7.9% budget deficit, 7.9% of GDP. They don't like that. That's why we've seen bonds lose a lot. You're heavily invested in bonds, in Polish bonds. Which way are they now headed?
Well, they didn't lose a lot, so yes, they corrected a little bit in the last 3-4 weeks, mostly because of some outflows from emerging markets, but they still have a positive year-to-date performance, and this trend just gonna keep on going because it's not a trend change of what we've seen in the last weeks. So there is still a lot of short-term money inflow into the Polish local bond, and the spreads to Germany is so high that I don't think that the trend will stop here at the current point of time. And the fiscal deficit, it's not such a big problem in Poland. Yes, 7.9%. The figure is a little bit higher than maybe in some neighbor countries like Hungary, but Poland had room to implement some counter-cyclical measures back into the crisis, and right now they have like 2-3 year time just to implement some cuts, and I think they promised to cut the deficit this year to 5.6%. They're on track to do it, and for the next year we can expect that they would reduce it maybe to around 3%, maybe a little bit more higher than 3%.
And crucially, the economy is still growing. So what specifically would you recommend to investors in terms of the bonds there?
Well, the uncertainty is still very, very big, mostly because of their nervous external environment. If we have some bigger banking consolidation program within European Union, I think the Polish bonds and currency would rally hard. So for some more aggressive investors, I would recommend to buy unhedged 10-year bonds, or maybe even shorter term bonds, 2-year bonds, zero bonds. But for more conservative investors, it will be interesting to be invested into middle part of the curve with hedged currency.
Right, so there's a lot to you expect that to rally. Where are the other opportunities in Eastern Europe? Because you also cover other countries.
Well, a very nice opportunity is Turkey. The currency is cheap, and after we've seen around 100 basis point rise in the short-term yields, I think it's a pretty good long-term opportunity to start investing into Turkish local markets with the idea to receive around 9% for 1-year T-bills. And another very interesting opportunity at the current level of ruble is to invest into local Russian debt market.
Turkey and Russia. All right, Dmitri Barinov, we have to leave it there. Senior Portfolio Manager at Union Investment Privatfonds. Thank you very much for being with us.